For years, artificial intelligence was a software story. Now, it is a story of physical steel, power, and massive infrastructure. The market is no longer asking how smart the models can get. Investors are enforcing a strict mathematical test: how much cash is going out, and exactly how much is coming back in. This chart shows the projected 2026 capital expenditures for 3 companies. Microsoft expects to spend roughly $190 billion. Alphabet plans for up to $185 billion. Meta projects up to $145 billion. Add those up, and you cross $500 billion in planned infrastructure spending. That $500 billion figure doesn't even include Amazon. The total industry investment is even higher. We know these companies are buying chips. The central tension is whether the economic return can scale fast enough to justify this level of spending, and the heavy pressure it puts on their profit margins. The demand driving this build-out is very real. NVIDIA just reported $81.6 billion in quarterly revenue, an 85% increase from a year ago. But absorbing that hardware carries immediate financial consequences for the buyers. It compresses profit margins and burns through free cash flow long before the servers reach their full earning potential. This visual represents return on invested capital. It is the strict metric Wall Street is using to weigh that $500 billion upfront cost against the actual revenue it eventually produces. To evaluate if this spending is demand-led or dangerously speculative, we are going to build a 5-point scorecard. Surviving this earnings season requires tech giants to prove they are actively monetizing their infrastructure today, rather than building massive server farms and hoping the customers arrive later. Let's break down the 3-layer AI supply chain. Layer 1 is infrastructure demand. NVIDIA sits here with 85% revenue growth and a massive 74.9% gross margin. These numbers prove the hardware is actively being purchased and deployed today. The current profitability is extraordinary, but that success creates a near-impossible benchmark. When a business is already operating at a 75% margin, beating estimates becomes increasingly difficult. Because valuations across the sector are so elevated, future upside requires sustaining exceptional growth. Simply proving that demand exists is no longer enough. At the infrastructure layer, a company can report excellent results and still watch its stock drop if forward guidance misses the market's aggressive expectations. Moving to Layer 2, cloud monetization. This tier tracks Microsoft Azure, Amazon Web Services, and Google Cloud. A sharp upward trend line shows Microsoft's AI business passing a $37 billion annual revenue run rate. That is the positive side of the equation. Massive capital spending is converting into faster revenue growth and durable usage, like Google's $240 billion cloud backlog. Here is a chart showing the other side of that trade-off. Buying shorter-lived assets like GPUs requires heavy upfront cash. While Amazon's AWS revenue climbed 28%, their trailing 12-month free cash flow fell from $25.9 billion down to just $1.2 billion. This creates depreciation debt. Buying hardware drains cash flow today, but the accounting cost of that equipment drags down the income statement for years. Hearing management complain about capacity constraints is actually a green flag. It proves they are building because customers are actively waiting to rent the servers. The warning sign appears when capital expenditures repeatedly grow much faster than the cloud revenue they support. That breaks the investment thesis. The cloud layer is the exact point of tension this earnings season. Investors must weigh long-term capacity building against severe short-term cash consumption. Layer 3 is application-level profit. Companies like Meta and Alphabet need to show that AI is making their core software, advertising, and operations more efficient. Meta provides a clear example. AI is improving their ad impressions and pricing power, but the risk is data center costs climbing faster than the advertising revenue needed to pay. To cut through the noise, here is a 5-point scorecard to evaluate any AI stock. Row 1 is cloud growth. Accelerating numbers prove customers are absorbing new AI infrastructure. Row 2 is backlog. Growing performance obligations confirms demand extends beyond a single quarter. Row 3 compares CapEx against revenue. Spending big must scale proportionally with the business. Row 4 tracks gross margin and depreciation, watching for hardware costs compressing margins. Row 5 is free cash flow. A persistent decline without proportional revenue growth is a major caution signal. These 5 accounting metrics track the actual movement of capital. They offer far more clarity than product demonstrations or a CEO simply repeating AI. So how should you actually apply this scorecard? It depends on which of these 3 investor profiles matches your strategy. If you are a momentum or growth investor holding concentrated AI positions, you are targeting maximum upside. Your thesis requires cloud growth to accelerate right alongside the capital spending. The trade-off is accepting high volatility. If cloud growth slows down but the capital expenditures remain elevated, you have to be prepared to exit. If you are a value or fundamental investor, your strategy is different. You are waiting for free cash flow to stabilize before committing capital. By waiting, you lower your risk of buying at a cyclical top. But the cost is that you will miss the early, explosive phases of the rally. Finally, if you are a portfolio allocator with broad index exposure, you benefit passively from this tech infrastructure monetization. But you are implicitly accepting an era of historic capital intensity. For index holders, Amazon's free cash flow and Microsoft's Azure guidance are the critical proxies. They reveal if the industry's massive spending is producing the cash and customer demand needed to support the valuation of the broader market. Focus on the measurable return being earned on capital, rather than the simple fact that spending is rising. In this environment, mathematical confirmation carries more weight than a promise of future growth.